Real estate investment practice problem using OneNote. Points explained with the help and use of pivot tables, part 2. Get ready because it's time to raise the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab down in the 4190 Points Explained Pivot Tables Part 2 tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. In a prior presentation, we discussed what points are and looked at some tools that we can use in order to compare and contrast whether or not it be beneficial to purchase points or not, and compare and contrast different loans structured differently. We're going to be continuing on with that discussion, this time adding more tools, including a pivot table, and then breaking out the information into, instead of a 360 period worksheet, which is an amortization table, what if we were to summarize that data, summarizing it into the 30 years for a 30-year loan? There's going to be some pros and cons of doing that. Note that we do go through this practice problem in Excel, so you can work through it in Excel if you so choose. We also have the Excel worksheet, so if you want to use the Excel worksheet, think it might be useful for your decision-making processes, you can take a look at that as well. So we have our starting scenario here. We're going to say the loan is, or the home, $200,000, nothing down, just to keep the loan nice and easy at the $200,000. We're going to have a 30-year loan. The months then are going to be 360. So the problem that can be very daunting when looking at something like this is when you're trying to go back and forth to an amortization table, which is 360 periods long, especially one that doesn't label the year or what the year is, and especially if you're going back and forth to some other program, such as a calculator online or something like that. Is it possible for us to take that amortization table, break it down into a summary on 30 years, and use that for some decision-making processes, at least as a preliminary standpoint, before we get more detailed maybe in the full amortization table? So then we have the rate. We're going to say that's the starting rate before any points. We're going to say is 5%. We're going to add the points then. The points, we can say these types of points we're going to say are going to be there in order to buy down the rate. In other words, prepaying, in essence, the interest, or in other words, putting money down up front in order to get a lower interest rate. Most of the times that's because people are concentrating in on the payment amount and would like to get the payment amount as low as possible to feel that they can pay that payment amount into the future based on their income level. That's generally the idea. The next question, of course, would be, does it make sense financially to put the payment down up front in order to get the lower amounts of the payments? Okay, so if we say that we're going to say the points are going to be 3 points that we're going to have in our practice problem, each point represents 1% of the loan amount. Therefore, if we have a loan of $200,000, 1%, 0.01 would be $2,000. If we purchase 3 points, then it's going to be times 3. It's going to cost us $6,000. So we're going to say $6,000 cost of the 3 points. That $6,000 not being included in the loan amount up top, meaning we're still amortizing based on the $200,000. It's a cost over and above or outside the loan. It's not being rolled into the loan. In other words, question then being, is it worthwhile to put the $6,000 up front in order to get the lower payments that would result from that? Now, the next question is, well, how much decrease will we have from the payment of the points? This could differ from loan to loan. 1 point pretty much always means 1% of the loan, but the amount of decrease could be something that's more likely to vary. We're going to say it's 0.25 in this case. So that means we're going to have 0.25 decrease in the rate per point. So 0.25 times 3 points, that's 0.75 minus the rate of 5%. That means the new rate is going to be 4.25. So we got a 4.25 rate based on that $2,000 loan, which hasn't changed even though we put the $6,000 up front in order to buy down, in essence, the rate to that 4.25. That's going to be the general scenario. Now, the next question would be, well, is it beneficial to do that? One calculation that's useful for us, I'm going to call it the effective rate up top, is to try to say, look, these two amounts are making it confusing for me to compare to other loans which are structured differently, which have a different upfront cost and a different rate amount. I would like to roll these into one format in a similar way as if we were to analyze like a baseball player or a basketball player throwing free throws or something like that, and try to say we need a rate, we need a percentage in order to make the comparison. The first we can use this calculation for that percentage, which would simply be the rate calculation we looked at last time. But instead of adding the loan amount, we have the loan amount minus the $6,000 that we paid up front. That would give us 4.51. That rate would be a comparable rate that we can use for different loans that are structured differently if we use a similar kind of method for the different loans, including, wrapping in the $6,000 into, in essence, the rate. The problem with that is that in doing that, that only plays out over the 360 time period, and you're actually going to come up with a different rate here if you aren't planning on holding the loan for that full time frame, and that's when it basically oftentimes becomes more and more confusing as to whether it be a beneficial thing. So that's going to be one of our tools that we're going to have. Now, if I'm trying to look for like the break-even point, or I'm trying to see how long I'm going to hold something, it could be tedious to go through this amortization schedule because, of course, there's 360 periods that are involved in it. So if I'm doing analyses of multiple different loans and trying to figure out which would be best, is there some way I can approximate that, possibly crunching this together to 30 years and do at least a preliminary analysis based on that type of information? One way to do that would be to add a pivot table. We won't go into a lot of detail on how to add the pivot table. We've seen that in the past, but it would just look something like this. Adding the pivot table to the amortization table. Years are going to be in the rows. And then we've got the sum of the payments, the interest, the loan, and then the loan balance. That way, we can change our data nice and easily from either having points to not having points and simply refresh the pivot table. Then we can copy our information from the pivot table and make our analyses from it. Now, that means that anything we copy from the pivot table will have to be hard-coded or typed in. I can't use formulas because I'm going to be changing my data over here. That's different than what we looked at last time in the prior presentation. We basically copied and pasted the whole thing, the whole amortization schedule and data input. If we do that method, then we can use nice formulas to format everything. If you use a pivot table, you can't reference your data to the pivot table because you're going to be changing the data, which will then change the data in the pivot table. So that's one of the pros and cons here. But the idea here, now we took the points away. So now we've got the 5% here. We've got the 1,073.64 at the payments without any points purchased, without any paying down. Loan amount still at the 200,000. The payments, if we were to combine the payments together into 1 year, now being 12,884. In other words, if I took this monthly payment amount, 1,073.64 times 12, we've got 12,883.68. About 12,884, we're going to say. So when we look at a cash flow basis, I can say, well, why don't I try to look at a cash flow and look at it on a yearly basis for yearly cash flow that is taking place? That can be useful, a lot easier to work with this table than 360 pay periods. But the assumption that will happen when we do present value calculations, that's the problem, is going to be that 12,884, if we put it in terms of years as the period, will be assumed to be made at the end of the year, whereas in actuality it was made 12 times throughout the year. That's going to result in a slight difference in terms of our present value calculations. So that's what to keep in mind when you're doing this type of analysis. And then the interest is the sum of the interest, and the loan balance being as of the end of the year, also very important and very nice to have on a yearly basis, because that's going to be important to understand if we're thinking about selling. If I'm saying, hey, I'm going to sell this thing after 3 years, it's tedious to go through the amortization table all the way down 3 years, right? In order to find it with monthly payments, it's a lot easier to use the pivot table and pick it up from something like that. Okay, so now let's reanalyze our tools. Now remember, we're not using the tools yet to figure like a break-even point. We're just looking at the tools that we can use in order to make comparisons a little bit more easily. One of them is going to be that internal rate of return tool. Remember that all this loan stuff has to do with time value of money, and it's not too bad in Excel once you get these formulas down. So let's look at this from a cash flow standpoint. If we took it from a cash flow standpoint, and now we're looking at a situation where we do not have, we're at the 5%, we're not paying the points. Up front, we got 200,000. We didn't really get it, but from a loan standpoint, from the bank standpoint, they paid us 200,000. They didn't give it to us. They gave it to the person that we purchased a home from. So you can think about it kind of similar as we got the 200,000, then gave it away to pay the home for it. There's the 200,000 inflow. Then we have a 12,884 outflow each period for 30 years. Now it's not really 12,884, it's really 12 payments each year that sum up to 12,884, and that's where the approximation comes in. Now, if we were to take the present value of each of these cash flows, starting with the second one here, the first one would be the same, of course, because it's in period 0. Second one would be negative present value of the rate. The rate would simply be the 5% now. We don't have to divide by 12 because now we're in yearly bases, a bit easier to calculate, comma. Number of periods for this first one would be 1, that now representing a year rather than a month. Then 2 comma, skipping the payment because it's not an annuity, getting to the future value of 12,884. Meaning, if I discount the 12,884 back at a 5% rate for one period, which is 1 year in this case, we get to the 12,270. It's a little bit of an estimation because that's estimating that this whole 12,884 happened at the end of the year. It didn't. It happened in 12 periods. So that's where the approximation will come in if you use something like this. The second one, if we say the 12,884, second 12,884 in year 2, discounting it back 2 periods, 2 years, at the rate of 5% gets us to the 11,686. Now, if we did this all the way down and we summed up the payments, we get to the proper amount of payments for the entire loan, 360 periods or 30 years of the 186,520. You would think that the present value would get to 0 as it did when we did it on a monthly basis, taking 360 payments, discounting it back. It's not doing it here due to the fact that we have the present value calculation, adjustment, or that the rounding error due to the fact that we're not using months but instead of years. And if you take the internal rate of return, which is the rate at which this series of payments will be 0, meaning if I discounted these payments back by the 4.91, I would get to 0. This IRR you would expect to be 5 given this information, but again, it's not. That's going to be due to the rounding that's being involved with using years instead of months. So that's going to be the limitation. Now, if we did this and we added the points, let's do the same thing with the points. Refreshing the pivot table, we've added the points now, which pays down the rate to the 4.25. We have the same starting point of the 200,000 on the loan. The payment amount is now 983.88 per month. If I take that 983.88 times 12, we get to the 11,807 on a yearly basis for 30 years that are being paid. If we do that and we do our same calculation down below with the points being involved to understand this IRR return, this is where the twist comes in because the cash flow in year 1 is not 200,000, even though that's what we put into the amortization table. That's what we're amortizing, but really we got 200,000 in order to pay off the home, and then we had to pay 6,000, which is not included in the loan, but we had to pay it. So that's where the twist comes in. That's where the issue comes in. So the net cash flow is really 194 in period 0. And if I was to take the payments of the 11,807, discount them back, first one, for example, negative present value of the rate 4.25, comma, number of periods, which would be 1 year in this case, comma, because it's not an annuity, but present value of 1, future value 11,807, discounting, in other words, the 11,807 back by 4.25, which is the rate after the points that we're using on our amortization schedule, we get to 11,326. If I did that all the way down, once again, we don't get to 0. We wouldn't expect to get to 0 this time. We would expect to get basically to 6,000, and we're not getting there either due to the fact that we're using an estimation of years rather than months. If I was to then sum up this series of data or use the IRR function, saying what rate would be used to get this series of payments to 0, we get to the 4.426. That then is what you would think would be our effective rate, meaning the effective rate we calculated if we added points was 4.51. That's the rate or the IRR we got to when using months. So again, it's a little bit different here due to the rounding. It should be 4.51. If we did the same calculation in months, it's 4.426. So now we can compare, this 4.426 that's kind of annualized to the 4.91, which you would think would be 5%. Again, their changes due to the rounding of using years instead of the months. In other words, if I took this 4.426 and I did the same flow, meaning the 194,000 out, net inflow up front, and then I discounted the 11,807. These are the payments that would be made on a yearly basis, even though they're made monthly, but summing up the 12 payments on a yearly basis after paying the points, discounted each one back, not by the 4.25, but rather by the 4.426. So if I discounted the 11,807 back 4.426, I would get back 1 year 11,307. Discounting the 11,807 back 2 years by, instead of 4.25, 4.426, I get 10,827. Scrolling down, that then adds up to 0, just to prove that that is indeed the IRR is the rate at which this series of payments, if discounted by that rate, would be 0. That's what the IRR is. Once you have that tool, then remember this IRR is confused due to the fact that we had this cash flow up top, which is different than the actual loan amount. That means that when I calculate the IRR for each payment period, it's going to be different. And that's where the kind of confusion comes in if you don't have the loan for the entire 30-year time period when you're trying to make comparisons. So if we look at these three calculations just on a side-by-side, the first one, you would think this one was just to prove our tool. It would come up to 5%. It doesn't exactly because we're using years instead of months. It's not quite at 0 here due to the rounding. The second item here represents our calculation of the IRR after the points are being used. We can do a comparison of these two, and we could still say, even though they're kind of rounded, of course, the points come out to a better scenario if you were to have this for the entire time period, which reflects the fact that the actual cash flow, 186,521 times 0 minus the 162, is going to be beneficial with the point scenario if you hold the loan for the 30 years. And then this is just basically to prove that IRR works. So that's just so you can kind of look at these types of tools. Now then, if you were to work in a situation where you're trying to say, well, what if I held the loan for like 5 years or 10 years or something like that, then you can use these tools to basically figure out what the IRR would be up top if you held the loan for 10 years and possibly compare that to other types of loan scenarios as well as looking for basically the break-even point and find the actual break-even point in terms of internal rate of return, the effective rate, which can take a little bit more hunting. There's an easy way to kind of figure the break-even point, which isn't exactly precise, and then you can use the IRR, which is a little bit more precise, but it takes a little bit of hunting to do. So we'll take a look at those, applying these tools out in future presentations. Remember, we do work this problem in Excel if you want to work it through Excel, or if you just want to use the Excel worksheet to use that for your purposes, for your decision-making processes. Take a look at it.